Welcome to our Financial Insight series. It is Casual Friday, but I wanted to get this out as quickly as possible. Today, we're diving into the emotionally charged dynamics of stock market volatility. After the recent sell-off, here's where we are today. The Dow is up 130 for the year, the S&P 659, and Nasdaq's up 537. These are after the recent pullbacks. So let's put current volatility in perspective using the swings of last year. Despite multiple corrections, the Dow Jones Industrial Average still managed significant gain. In 2023, the Dow Jones Industrial Average experienced three substantial corrections. The largest drops of 33.52 occurred over 3 months, a second decline of 29.05 over 2 months, and a third fall of 978 points in just 1 month. Despite those sharp declines, the Dow still ended up 1370 for the year. The current trend is still positive, but I understand volatility can be emotionally stressful. Historically, there may be times to raise cash during these declines, but those times have been when there were significant economic events. For example, in 2022, the Federal Reserve Board raised interest rates substantially from 1/4 of a point to 5.5 in 12 months. And who could forget the banking crisis and real estate crisis of 2007? But what's different today? The economy has remained strong and consumer confidence has not wavered, which is crucial, as consumer spending is a key driver of economic activity. One concern remains, and that is inflation. And although it has slowed significantly, it continues to be a point of uncertainty. So what should you do in these volatile times? Well, emotions often suggest raising cash. But historically, those moves are not warranted only in times of substantial economic changes. We are not witnessing such events today. Look at the trend over time, which included many significant events. Over time and throughout all sorts of events, stocks still showed strong returns. Today, we are seeing a strong consumer, a tight job market, and slowing inflation. History illustrates this might be an opportunity rather than a warning sign. In a strong economic environment, market pullbacks can often present buying opportunities for long-term investors. This approach requires watching the broader economic indicators and not reacting hastily to day-to-day market fluctuations. It's about seeing the forest and not just the trees. While emotional reactions and fear may result in a desire to raise cash, historically that has not turned out to be a wise move. 2023 provides a clear example of why it's time in the market and not timing the market that proves to be the best strategy during these times. Those who fail to learn from history are doomed to repeat it. We're here to add historical content. Thank you for your time. If you'd like to discuss your holdings privately, please give us a call. And remember, we're here looking out for you.